Hi everyone, my name is James Lim from Stewardship Finance Academy. Today we are going to talk about recessions.
James, let me start our video by asking this question first. Are we in a recession now?
While it may appear that we are already in one, Capital Group believes that an official recession will not occur until later this year or early 2023. Despite the impact that high inflation has had on consumer sentiment and corporate earnings, the economy remains supported in the short term by strong labor market. However, the likelihood of a US recession has risen dramatically in recent months. So some people may wonder, what is a recession? A recession is typically defined as at least 2 consecutive quarters of declining GDP following a period of growth.
Isn't that the United States has already seen 2 consecutive quarters of declining GDP?
Yes, it is. However, it is important to know that this definition is insufficient on its own. Recessions, according to the National Bureau of Economic Research, are a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales.
What causes recessions actually?
Previous recessions occur for a variety of reasons, but they were almost always the result of economic imbalances that had to be corrected. Like for example, excess debt in the housing market caused the 2008 recessions, while an asset bubble in technology stocks caused the 2001 contractions. And as for recently 2020, an unexpected shock such as the COVID-19 pandemic, which was widespread enough to harm corporate profits and force job cuts, can also to be blamed.
Are there any signs of a recession so that we can prepare ahead of it?
Yeah, there are signs of a recession. Although the precise timing of a recession is difficult to predict, it is still prudent to consider how it might affect your portfolio. So whether you are an investor or not, you should be aware of potential recessions and prepare accordingly. So there are several indicators you can monitor to predict a potential recession, which may give you an advantage in preparing your portfolios. Number 1, inverted yield curves. So the inverted yield graphs show that the long-term interest rates are lower than the short-term lending rates. So instead of increasing as the maturity date gets further, the yields decreases. So normally, as the time to maturity increases, the yields goes up. However, during an inverted yield, the opposite is true. So this is frequently an indication that the central bank has raised short-term interest rates excessively, or that investors prefer long-term bonds to riskier assets. So economists interpret this as a forewarning of a coming economic downturn. The average time between an inverted yield curve and a recession is 14.5 months. Number 2, unemployment. When unemployment rises, consumers cut back on spending. So the average length until recession is 5.6 months. Number 3, consumer confidence. Consumer confidence appears to be related to economic strength. When the economy enters a recession, consumer confidence generally falls sharply. So when the economy enters an expansion, consumer confidence generally rises. So the average length until the economy enters a recession after consumer confidence falls from previous year is 2.9 months. Number 4, housing starts. So when the economic outlook is bleak, home builders frequently reduce their housing projects. The average time until the recession from housing starts down 10% from previous year is 5.3 months. So this table from Capital Growth reflects the market condition on August 31st, 2022 to see if a recession threshold is met for each of the indicators. So the inverted yield curve and declining consumer confidence are 2 indicators that have been met. So please keep in mind that this is not a magic formula for predicting every economic downturn, but it can help us to see the patterns on the horizon.
So can a recession be avoided if people can predict ahead of it?
Yeah, good question. Recessions are not logically unavoidable in any economy, but are determined by a country's monetary practices and institutions. So the COVID-19 pandemic caused the last official US recession, which lasted from February to April of 2020. Fortunately, the government and Federal Reserve acted quickly and aggressively to mitigate the worst-case scenario. During the pandemic, central banks reduced the interest rate and actively intervened in financial markets to prevent a long-term financial crisis, while the government also supported through stimulus payments, extended unemployment insurance, and business assistance programs. So these policy responses helped the economy quickly recover and avoid a deeper, longer recession. But how about now? Compared to the pandemic, we have a new challenge. That is the high inflation. Inflation we are facing now causes higher interest rates, which causes slower economic growth and possibly even a recession. The Federal Reserve has stated that it is currently more concerned with inflation risk than recession risk. Because the Fed wants to avoid causing a recession while also attempting to reduce the inflation, interest rates are likely to raise further as a measured pace.
So how long do recessions actually last?
The good news is that recession in the United States have typically lasted between 2 and 18 months, with the average lasting about 11 months, according to capital growth analysis of 11 cycles since 1950. That can feel like an eternity for those directly affected by job loss or business closures. However, for long-term investors, we can look at the bigger picture. Although painful, recessions can follow by tremendous expansions. Recessions has been minor hiccups in economic history. In the last 70 years, the United States has experienced an official recession in less than 15% of all months. Furthermore, their net economic impact has been minimal. The average expansion increased GDP by nearly 25%, while the average recession decreased GDP by just 2.5%.
How does recession affect the average person?
So during a recession, the labor market suffers. So during a recession, the worst case scenario is that you lose your job. Interest rates rises during a recession. When interest rates are raised to slow the economy due to rising inflation, a recession almost always follows. Higher interest rates require more payment towards the existing debt, and that makes you and the business more hesitant to incur new debt. During a recession, the stock market falls. Companies' earnings will be lower because consumers will spend less and inject less money into the economy. Even worse, when some investors sell stock in response to concern about the recession, rising inflation, and interest rate hikes. During a recession, everything costs more. Because of inflation-driven price increases, your money doesn't buy as much, making it difficult to maintain the same standard of living. So saving money will be difficult during a recession because your purchasing power will be reduced. Obtaining a loan during a recession is more difficult as well. So during a recession, even if you still want to borrow money despite the increased interest rates, lenders will be hesitant to lend money because they will consider your job security. So how should you position your stock portfolio for a recession? So Jessica, do you worry about losing money in your portfolio?
Yeah, I don't think anyone likes to see losses.
Yeah. Exactly. So no one enjoys losing money, even if they have millions to spare. People suffer the agony of financial loss more than the joy of receiving gains. So when the market begins to fall, people have a natural desire to leave the market. Just as the market rises, they tend to return out of greed. But both actions could be harmful. Equities frequently underperform during recession, but timing the market by selling stocks is not recommended.
So should investors remain passive and do nothing?
Certainly not. I'm going to highlight a strategy used by billionaires like Ray Dalio and Paul Tudor Jones. Because market sentiments can shift so quickly, these wealthy investors protect themselves by diversifying their portfolios with uncorrelated assets. So what are uncorrelated assets? Uncorrelated assets are simply investments that do not rise or fall in the same direction as the other asset classes in the portfolio. When market sentiment shifts, a small allocation to these uncorrelated assets can help protect a portfolio value. So during a difficult economic times, not every stock reacts in the same way. During the 8 worst stock market drops between 1987 and 2019, some industries did better than others, typically those with higher dividends, such as consumer staples and utilities. When stock prices are generally falling, dividend may provide a more stable return. Although alternatives such as cash, commodities, and real estate can help diversify a portfolio beyond traditional stocks and bonds, many analysts believe that gold is undisputable king of uncorrelated assets. So gold price frequently rises even during downturn markets due to its long history, defining the general rule that it does not fluctuate with the stock market.
But gold has not been performing well lately.
Yes, you're right. Having said that, gold has not performed well recently because gold is priced in US dollar. So when the dollar is strong, gold appears relatively weak. Also, a lot of gold buying is made with leverage. In the high interest environment, the cost of owning the position increases. Furthermore, unlike stock, there is no dividend payout for owning gold. Though gold is widely regarded as an inflation hedge, the stock market has proven to be a far better inflation hedge over time. Gold, on the other hand, has a solid track record as a hedge against portfolio volatility caused by geopolitics, systematic risk, or recession fears. While its performance has been disappointing so far during this bear market, a portfolio with gold allocation would have had less volatility and outperform a portfolio with 100% allocation to equities. So what do you think? Please take a moment and comment below your bear market investing strategies so that we can all learn from one another.
When do recessions end?
There have been numerous types of bear markets, each with its own depth and durations. The Investopedia chart shows the length of S&P 500 bear market in months, the loss percentage, and the time it takes to recover. The average bear market lasts 11 months. The average percentage decrease is minus 30.3%, and the average recovery time is 19 months. So what should you do to prepare for a recession? Above all, keep your cool when making investments before and during a recession. Good investment returns can be hindered by emotions at times, particularly when the economy and markets are under pressure. Sharp drops in stock prices during a recession may present good investment opportunities. The market may undervalue some companies. Others may have a business model that makes them more resilient to a downturn in the economy. If you can identify these companies, your return will be great during the expansion. However, there may be reasons to back off as well. Okay, so we are here to help. SFA specializes in transforming beginners into competent investors. People come to us when they want a complete start to finish investment education, as well as a mentor to guide them step by step, especially if they want to take advantage of the opportunity to buy undervalued stocks during the recessions. You'll feel completely confident in your decision to invest in stocks. So to learn more, click one of the links in the description. The most straightforward option is to arrange a free consultation with our advisor, who will be able to answer your questions and guide you through the process. Lastly, if you like this video, you can hit the like button so that YouTube knows what video to recommend to you in the future. Don't forget to subscribe to our channel before you go. Okay, see you in the next video.